Hey traders, this is going to be a little different tonight. I had an issue with the microphone. I ran out of time. I have to be somewhere and I couldn't re-record the video. However, there is a video. It's difficult to hear. You're going to have to turn up the volume and you're going to have to tolerate a microphone that was not selected in the recording software. I apologize. The information is there. It's just difficult to hear. Forecast for another episode of Common Market Analysis. Today is Tuesday, September 19, 2023. We're looking at which is the proxy for the S&P. The first thing we'll notice is the most amazing close relative to where the market was in the morning. May not seem like much to the naked eye, but I'm telling you there's something to this price. What price am I talking about? The same 442.46, that breakup candle low. When you look at the intraday chart, look what they did in the afternoon. They rallied way back from the doldrums from 440. We'll get to that later. Hold your horses on the 440, because we already talked about that one, not necessarily yet today, but we talked about it yesterday, the day before, yada yada. Plus, there's a little surprise with 440. But in terms of the 442.46, they rallied right back to close above it by the end of the day. I find that not only interesting, but I also find that for the time being somewhat bullish. Now, when we talk about bullish, we have to be careful because why? Because we have Kabuki Theater / the FOMC announcement tomorrow afternoon. Then we have Jerry's presser after the fact. So the markets can certainly whip around, but as it stands, at face value, that's a bullish move. There's no two ways about it. The market knows about that number. It got far away from that number from an intraday perspective, and it rallied back to close above that number. And it's a number we've been watching for a while. We know about that number. It's uber important. Check this out. Let's turn our attention to 440. So basically 440 was low of day. The actual number was 439.94. And on the daily chart, it looks like it was a gap from the day before over here on the 28th, or pardon me, 25th of August. The Monday following, it looks like they filled that gap on the 28th and took off and broke out above. However, if you remember, we talked about this at the time. It was what we call a shenanigans tail candle. And I was reminded of this by Chad in the room today. That was never down there. Price was never down there. And if you look over here on the left, this is the activity from that 28th of August. And look at the low on that day. The low in this candle was 440.90. The low in this candle, 440.86. It was never at 440. They didn't get down there until today. They filled that gap, took care of the shenanigans tail candle, and took back off in the other direction. Now, for now, it's a bounce in a downtrend, but consider the fact of where they closed today, and we have Kabuki Theater, anything goes. You got to throw out the charts tomorrow afternoon for a while. It's a spectator sport. Now, what if they kill the tape after the FOMC announcement, after Jerry's presser, during all that stuff, whatever it is? What happens if they kill the tape? What happens if they send it down? Where is the next place of interest? 437 to 438. Anything below that starts to get into the vicinity of that 100-day moving average right up here, right around 436 and change. What happens if they jam the tape up? 447.50 will be overhead resistance. If they can get above that, there's another leg higher. Write that stuff down. You never know. Let's take a look around the horn from a trend perspective. Let's just get a visual of a variety of different charts. So we know the weekly is still above all the moving averages. The trend is your friend, but consider the fact that things morph from shorter time frames. Trend changes from a shorter time frame into the larger time frames, not the other way around. So the weekly chart will be the last time frame to change trend, notwithstanding the monthly. We're just going up to the weekly for this conversation. Daily chart hovering below the 50 and the 20 period moving average. We're going to use that place the 442.46 as our benchmark. That's our bogey. It's been our bogey. It remains our bogey. Closing daily below that and confirming below. So one day they can pop back up. They could have done that tomorrow if they closed below it today. But you start closing down there more than one day, and the evidence is building that they're giving up the half-day chart. Below the 120 and 50 period moving average, last moving average line of defense is the 200. There's a trend line that seemed to be valid today. Spike below, right back up above. The 180-minute chart, below all the moving averages. The trend is your friend. The trend is down. Think about what I said before. Just looking at this chart and this chart alone, the concept was, hey, look, if they can get above 447.5, and guess what? Where that is? Right here at the top end or right above these moving averages. So if they spike up above these moving averages, can they stay there, close above this breakdown candle high, which opens the door for all this space up to 450? There's a big convergence of moving averages in this zone. Can they actually get through it? Well, if they're going to get through it, tomorrow's a good day. If they're going to drive the tape higher with the Fed announcement, the FOMC, Jerry's presser, they're going to have the volume and the juice behind the market in either direction to move the tape. 2-hour chart, below all the moving averages. The trend is your friend until it's not. Same routine on the 1-hour chart, below all the moving averages. You take the market at face value. The most important number on the board, and I think we can all agree on that now, is 442.40 in the S&P or SPY. What about inside the numbers today? We'll take a look. What I urge you to do is pause the video, read the notes, and go back to the chart to double check the work. Everything we need is in here. In all fairness, I really didn't think the market would get down to 440 today until they started getting below 441.80. And you'll see that in here. That's basically a line in the sand. They were going to get below that. It was going to be another leg lower. So around 8:45, what's the scoop today? Well, we've got 443, give or take, is the early big spot and gateway. Gateway to what? 441.80. They can bounce them around 443. That was the first thing on the board. But right before the opening bell or leading into the opening bell, they started leaking price. Price leak. They were dropping the tape. We call that the pre-market thieves. They reached the zone. Yesterday's low was 442.56, and the next number down is 441.80. If they were to get below 441.80 and stay below on candle closes, the door would begin to open for a trip down to 440. So that was on the board at 9:05 a.m. I did think it was the unlikely scenario, but doesn't matter what I think. We have the just in case are on the board. You know the stuff. It doesn't matter what anybody thinks. For now, the bounce back in the other direction place, this is at 9:05, is around 442.56 down to 441.80 and anywhere in between. But let's pick a spot in between and use the 442.46. We all knew about that number this morning. That was a place that a lot of traders entered right around there, maybe a nickel or a dime above. And what did they get? They got a ride up to a high in this candle of 443. It gave us our 5 to 7, 8 S&P handles. That's our scalp with potential. We don't let the rest go bad. So therefore, when they come back down, if they come back down, we don't let the remaining portion after we've taken a profit go sour on us. We don't let the remainder go bad. Therefore, we can always play it again, say and buy it lower, make another trade, but we want to pile up the base hits. That's what we're trained to. Moving right along. They open right in the showtime zone. Quick bounce. They can do both, meaning go back and forth for a while. A spike of 443 or thereabouts is an exit for the scalp portion. You take what the market gives you. Traders took the scalp off, and that was it for that trade. Now we're focused on 441.80 if they come back down. Now, as you can see, that number didn't work. They blew through it. They tried to run a back test. They didn't even get there, and they started heading down to 440. Good news, bad news. Some traders got caught in this trade. Some traders got out of it because they bought another number I put up on the board, 441.14. You'll see that show up in the notes momentarily. And then I got a plethora of emails this afternoon from traders that bought 440. Well done to the laundry list of traders that bought 440 and took a very nice ride up in the afternoon. I leave the morning session each and every day saying don't do stupid stuff in the afternoon. That did not qualify as stupid stuff. That qualified as nice trade. Pause the video, read the notes, go back to the chart to double check the work. 10-12. 441.14 is around the last line of defense before 440. I have it at 440.40. That was a number, and then I said to the live room, well, if they're at 440.40, you have to realize they could easily get to 440, so that was like the same number. And again, pause them, read them, go back to the notes and the charts to double check the work. You can see here, 440, and a spike of it is now unfinished business. How about stocks on the move? We had two on the board today. We had Starbucks and Deere. We'll take a look at those charts. Remember, earnings season doesn't get fired up for a couple, 3 weeks. They just trickle out one or two at a time leading up until then. Starbucks getting its buzz cut at the open, played games with the number early on, leaked lower, never got to the second number. It's not even on the page. They rallied back to close above the first number. It's not a good trade. It's not a bad trade. It's just a dud. The numbers work. And then you got Deere, buzz cut at the open, 402.15, 399.03 were the two numbers. You can see what happened. They bounced right in between them at the opening bell, and then they came back to retest the second, worked their way back. The numbers worked. They just didn't give you any kind of Whopper or Whopper Jr. They didn't even put a piece of cheese on the burger on this stuff today. Now this is more important, the stuff that's going on over in Camp IWM. So they had a down day, and they were teetering right on that neckline yesterday, right above it. Well, today they closed below the neckline. So from an official standpoint, this head and shoulders pattern is triggered. What happens if? What happens if they close back above it tomorrow? Well, then it's untriggered, and it's off the table. If they continue lower, it stays active. It's that simple. That's right out of the textbook. I didn't make that up. I don't have a patent on the information. That's just the way it works. We've been eyeballing the IWM for a while. Once they got below 184, no dice, no good. And they're leaking. They're weak. They've been weak. We've been talking about it. When you look at the weekly chart, what do you have? You have a series of lower highs. That's a problem for a chart. They're below all the moving averages. On the weekly chart, the trend is your friend until she throws your shit out the window. 178, give or take, to 179 is going to be the next place below for Camp IWM to find some semblance of support. However, everything gets thrown out the window with Kabuki Theater tomorrow afternoon. What about the folks down at the transportation department? I've been talking about 15,000 for I don't know how long. They almost got there today. They came up a little bit short, and by golly, they went right back above that 100 period moving average, right back above this low here that looked like it was going to crack earlier in the day. It's all about how they close them, not where they trade them throughout the day. It's where the closing prices are. That's important. If the market decides a closing price is to be, you can rest assured that that price is way more important than any price they visited during the day. Certainly with exception. They can visit important during the day like they did in the spiders at 4. But the closing price above that breakdown candle high in the spider, certainly uber important. It's how they close them. This is still weak. They still haven't gotten to the 15,000. And again, everything gets thrown out the window from a chart perspective for a few hours tomorrow afternoon. And by the way, this week will be an important close. Not closed yet. We've got a few days left in the week. However, look where they are relative to that home base or 20 period moving average. Are they going to close above it or below it? On the week, close below it, and it's going to open the door down to 14.5, 14.6, 14.7 pretty rapidly. What about the Q people? We'll start on the weekly chart. They're above all the moving averages. The trend is your friend. This breakup candle low coming in at 364.25, kind of coinciding with this home base or 20 period moving average. That's a big spot. You give that up on weekly close, that'll be a problem for the bulls. The daily chart is below the 20 and the 50 period moving average, and look where they are. Here's a breakup candle low. They almost ran a test of it today. The low is 366.23. The low today is 366.80. That's a big spot. It's a similar spot, if you will, to the same one in the SPY. They're not in the same position on the charts. They're not that far apart. All charts act and react the same way, but that doesn't mean that the NASDAQ in the same position as the S&P, which is in the same position as the IWM. They're not. They're all independent from one another, but they all do the same thing when they get to those same places, if you will. How about the financials, the XLF, staying above all the moving averages? Is this somewhat of a canary in the coal mine? The banks are being held up somehow by somebody, if you will, leading up into the FOMC announcement. Instead of dripping lower like a lot of other stuff, they're being held up above all the moving averages. I find that interesting. We can't directly do anything with that information in front of the Fed meeting, but I think it's of note. I think it's some kind of puzzle piece. I'm certainly putting it on the table. And then you have Smashmouth teetering at that 100-period moving average. This pivot low is a last line of defense, if you will, before another leg lower ensues. And from a weekly chart perspective, closed last week below and remain below this week that 20-period moving average or home base. They were riding it. They're no longer riding it. You can see how things shift slowly. Likely to get some movement tomorrow, maybe for the rest of the week, but you can see how, generally speaking, when you look at the longer-term charts, these things shift slowly. Not all the time, not 100% of the time, the majority of the time. If I told you how much I appreciate each and every one of you, without you, these videos are not possible. That is true and accurate information. We're pulling the ripcord here today. I'm David Frost, my strategic forecast. Thanks again for tuning in to another episode of Common Sense Market Analysis.